All right, testing, 1, 2, 3, testing, 1, 2, 3. I like your margaritas. Make it strong, don't you be a cheetah. One sip and ooh la la la. I love tequila. All right, good morning. Happy summer. Where's everything? I got to find everything. All right. So let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Welcome to Forex.Today, the YouTube channel for foreign exchange traders. There's almost 14,000 of us scattered around the world. And every day at this time, we get together to realign our satellites and synchronize our watches. Today, we'll cover technical analysis and fundamental analysis. I highly recommend that we go through the calendar looking for risk events for the week. Also, please ask questions, take notes, get involved, treat each other with dignity and respect. I'll do my best to answer your questions. Thank you for being a subscriber. Thank you for leaving likes. Thank you for leaving comments. KG says I look about 5 years younger. Yeah, boy! Yeah. It's amazing, huh? A little bit of R&R. Cool. Well, I appreciate that. Thank you very much. All right. Sponsor of our community is tradersway.com. Please visit tradersway.com and tell them thank you. You do that by signing up for a demo account, giving them the opportunity to earn your loyalty and respect. And then when you're ready to trade real money, you choose Traders Way to be the prime broker to your successful Forex trading business. And perhaps your success started here. So pay it back. Thank you, Traders Way. Thank you, Traders Way. Throw your diamonds in the sky. Without further ado, thank you, Kemi. What's up, Pure? Okay, cool. La 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 la. Before we get to this, g'day, mate. Let's move over here. Ooh la la la. I love tequila. All right. Boom. How was the beach? It was horrible. Turns out President Trump's going to spend 4th of July. Right there. Like, huh, that's interesting. And I found it interesting that people knew it. I'm like, what do you mean? Wouldn't that be a security risk? But anyways, everybody knows he's going to spend 4th of July there. Oops, trying to get this to fit a little better. There we go. Also turns out to be the #1 beach in America. Very cool. So anyways. All right. So, la, 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 la. I love tequila. All right. So what's going on today? RBA meeting minutes. Right? You must read, must read, must read. Okay? Bank of Japan. Must read, must read, must read. Okay? No, Hope, I had a fantastic time. It was a bad time at the beach is what I was kind of saying. There we go. No. Jekyll Island. Jekyll Island doesn't really have a great beach. I've had a picnic on the beach. And the great thing, like, about places like that, you just pick up the phone, you're like, yeah, I need a picnic basket, and I need it sent to the beach, and I'll need some bicycles, and when I get there, I want my lunch to be waiting. Sir, yes, sir. So I've had some good times at Jekyll Island, but you get there, and it's the Atlantic, and it's windy as hell, and all that kind of stuff. So But we'll do a Jekyll Island trip when I do my Forex tour. I still want to do that. I feel like I have all this free time showing up. What am I going to do when there's no Harvard? Anything I want. Anyways. All right, so lots to do today, by the way. Like, you need to print these out. Okay? You need to print these out. Okay? All right. La 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 la. Okay, U.S. retail sales. Yeah, I mean, and we know things were bad, but the thing is, now the question is, what's the rate of change in towards the direction of good? Okay, so this is going to like, it's not the headline number per se. It's how much does it support the idea that the worst is over? Okay. La 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 la. Export data out of Japan would be very interesting. Okay, because this has changed. Well, first of all, it's a sign of whether people are buying Japanese stuff, right? So we want to see exports because we know they're an exporting nation. And then it changes sort of lots of other things. Like, for example, do you think India has exported the normal amount of goods since February, March, and April? It's a question, yes or no question. Have Indian exports been at the normal pace during COVID-19? Okay, so what has the central bank done? Well, they can't print money. Only the reserve currency can print money. Printing money doesn't work for developing countries, developing economies and emerging economies, because it just creates rampant, nasty inflation. Set rates, no. Corruption, that's always there. Print money, no. Kept interest rates low. Well, that's not a response to exports. They bought bonds. Well, let's explore that a little bit. What they're worried about is their currency appreciating, because not only do exports drop, but imports drop, and people in India bring money home because they might need it during the crisis. And all of this creates an overvalued currency, which then, has negative effects on their economy. Okay, which eventually it makes their exports more expensive, at the very least, right? It also creates deflation and all that kind of stuff. Okay, so what the Bank of India has done is they've bought foreign currency, which is very similar to buying bonds, as Edward says. Now, I think what Edward might have meant was bought their own bonds. Well, that's what the United States would do. An emerging market can't really do that. It has negative consequences. But let's just put it this way. They bought foreign currency, which floods the market with the rupee, and lowers the value of the rupee, which then makes their products more attractive to foreign countries, because that's what they want to do. They want to export, correct? So right now, the Bank of India, has more foreign exchange reserves than ever before in the history of the world. They're ready to export. So it's just kind of interesting, the responses to things like, why do you look at import and export data? Well, this is interesting because we know Japan wants to export, and if they don't export, what happens to the currency? so on and so forth, right? So you have to always follow the circle of money. So now, as the world's economies reopen, let's say, now the RBA, or sorry, the Bank of England, gee whiz, the Bank of India may have too many foreign exchange reserves. All right, but the point is they're trying to keep their currency weak because the conditions they have now strengthen the currency, and that's unwanted. Cool. Okay, skip. Okay, CPI out of Great Britain. Does anyone really care? Okay, they don't have inflation. Great. Europe, same thing, right? Does Europe really have inflation? There's no inflation, dude. All right, Canada, a little more interesting. Okay, a little more interesting. I mean, for example, there isn't like Brexit going on for Canada. So we're a little more interested in this. And again, are there signs of recovery in the Canadian economy? Okay. Core as well as headline. Kiwi GDP. Sure, we always like GDP. Okay. Good GDP is better than bad GDP. So we'll look for that. Will it be a big deal? Maybe a little bit for New Zealand. Of course, it's backward looking, so we don't really. I mean, right now we're worried about the future, not the past, right? Like, do you want to talk about the stock market for a second here? We're at all-time highs again, right? All the losses of 2020 have been made back. And we're at all-time highs. At or near all-time highs. So we're now profitable again if you've invested into the stock market. Cool. Great. Isn't that nice? What does it mean? Does anyone want to take a guess? Like, what does it actually mean? Literally, what does the stock market mean? What are people assuming when you do the valuation of a stock? Where's my drawing tool? I guess I'll have to fire up a drawing tool here, probably. Epic. Where's my EpiPen? Epic. Hello. Epi. Why is it not doing anything? Wow. It's time to get. I wish the world ran on Linux. Weak dollar, it doesn't mean weak dollar. Weak dollar might be a result of that, of the similar economic conditions, risk on speculation. No. Okay, you're not understanding the question. It's cool. It's a hard question to ask. So let me get my pen here. And because I don't know how to. All right. So what it means is wow. Hang on. Let me try this again. There's a bit of a lag. Delete. And you know what? Let me clear this chart a little bit. Okay, what does it all mean, Basel? All right. It means, wait, my phone just gave me the dying signal. Where's my plug-in? Plug that sucker in. All right. It means the expected return. How do you put this? Expected return of a stock. is equal, what is it? The risk-free rate of the return plus the beta times the expected return of the market expected return of the market. I think it's just minus the risk-free rate of return. Is that right? Does anybody know? That's right, isn't it? All right. The expected return of a stock is equal to the risk-free rate of the risk-free rate, which would be like the 10-year T-note, plus the beta times the expected return for the overall market, which is the beta, right? So you got to take the beta plus the risk-free rate of return. So beta plus the 10-year T-note, right? Times the expected rate of the market, neutralizes all that, minus the risk-free rate of return. And you get the value of a stock or the stock market or whatever if you want to take it further. Okay? What this means is this. Here's one way of interpreting it. Because the stock market now is at the all-time high, we are now saying that 2019 is equal to 2021 because we're valuing everything on the expected return of the stock market for 2021, the future, next year. At the very least, next year, right? So if the current market is worth the same as before the crisis, therefore we are anticipating that we are at the same levels of earnings as 2019. Companies are just as profitable. They're earning just as much money. Their profit margins are just as good. Everything next year, based on their valuation, the expected return of a stock, right, is exactly the same as 2019. Because right now, the S&P 500 is worth the same as 2019. So we're not trading this year, we're trading next year. You see what I mean? How many people agree with this statement? Is next year going to be just as good as last year or not just as good as last year? Okay? Well, you have to ask about what are their profit margins going to be. So revenue minus expenses. Have expenses gone up? Well, then revenue has to go up more. Okay? If revenue is the same but expenses are more, then they're not going to be as profitable. Okay? Is Apple, for example, if you look at their revenue minus expenses, okay, is equal to 21 years. Is the value of their stock. So you are paying 21 years of profits per share to own Apple. Lihoo, sir, kind of person does that? Okay. So really, you want to look at revenue minus expenses, profitability, and will next year be as profitable as last year? And if so, why or why not? I mean, so these are big questions, right? These are big fundamental questions. Another sort of basic thing here to think about, especially when you're looking at 21 times earnings. Like, holy crap, really? 20 times 2019 earnings? Holy crap, that's the value of a stock? Wow, no kidding. So obviously the value of Apple does not equal what I drew out here. Therefore, Apple is incredibly overvalued. Like double it and then double it again. Okay? So these two things don't equate. But here's probably why, and we're getting back into behavioral finance again. What is a normal balanced portfolio? Stocks and bonds. What is the normal percentage of stocks and bonds in a traditional portfolio? If you sat down with your wealth manager on day one, what do they recommend? Yeah, but still, you can answer it. Yeah, I'm going for the 60/40 is what they tell you. 60/40 is left over from the 1950s. Okay? Because in the 1950s, they looked at things like this and things were different. So I think this is dumb. This is the capital asset pricing model, but this is what they teach in business school. Okay? What this says is essentially your stock trades like a bond, that you're collecting dividend payments over long periods of time. And that the future value of cash flows of your dividends are how you price out a stock. Does anyone believe that that still is how stocks are priced? You look at Coca-Cola and you say, well, it's paying me a 3% dividend, so therefore if I calculate that out and extrapolate it, then I'm going to have a certain cash flow income, and therefore over time I can create the value of the stock. The interesting thing is back in the 1950s, stocks and bonds were very, very, very similar. Okay? The interesting part of a stock is not only did it pay you dividends, like a coupon payment, but it could go up in value, right? And you could sell it. So there was a lot of similarities. Right now, in the real world, the stock market doesn't price Apple based on dividend cash flows. Okay? So since maybe the 1980s, the bond market represented something a little bit different. It said, look, the stock market goes up and down, up and down, up and down. It's crazy, it's volatile, it's hard to depend on. You need a dependable income because the stock market is no longer a dependable income. You're buying the stock because you think the stock will go up in value, not because of the future value or the present value of future cash flow statements, right? So then wealth managers got together in the 80s and said, well, a balanced portfolio is 60/40, 60% stocks because you're going to do well on the short run. But on the long run, having steady income from the US government, where you could buy a 10-year T-note and earn 8%. And if you just held it for 10 years, you'll double your money. Okay? And that was really good. And you would buy it and hold it forever. So they're still preaching this, of course. Okay? The problem is the bond market is no longer, it's no longer like that, is it? Right. Brad says stocks are more. You're right. So that's appreciation, right? Value appreciation, but not because of the dividends. So the stock market has radically changed, but your wealth manager might not understand that because he's still doing what he was taught in some other place. So, anyways, so now the stock market doesn't trade on the present value of future dividend payments, right? But the bond market doesn't trade on either, right? It used to be able to buy a 10-year T-note guaranteed by the government and earn, let's say, 6%. And if you wanted to take on a little more risk, you could loan a business money and earn 10% or something. But right now, bonds earn zero or nearly zero, and they're not paying you for the risk. And the 10-year T-note is like 2/3 of 1%. So if inflation is more than 0.66%, you're going to lose money over 10 years. So what has happened to the bond market? Should you put 40% of your net worth into the bond market? Funny thing is they still preach this, whether it's 75-25 or 60-40, they still preach this because they think it's the same as 20 years ago and 10 years ago even. It's over. The models they teach at business schools and the advice you're getting from your wealth manager is fallacious. It doesn't work anymore. It doesn't make any sense. So what's happening is money is going to the stock market, and you're buying Apple at 21 years, right? 21 times earnings. But you're betting it's going to go to 28 times earnings or 33 because there's nowhere else to put it. Well, Brad, but then you can get killed by emerging market currency valuations. Okay. So there's risk there for sure. And there's also a very high risk. The reason you earn high yields in emerging markets is there's a pretty reasonable chance you're not ever going to get paid. Okay? All right, so anyway, so this is moving closer and closer to 100 and 0. And therefore, there's nowhere to go but up because there's only up. And the interesting thing about a bond is it's just become not an asset. It's always been an asset. It's become, oops, I killed the whole thing. Let me redo this. It's just become a trading instrument. I know I misspelled it. But anyways, what I mean by that is today you might sell treasuries, tomorrow you might buy treasuries, you're long, you're short, you're short, you're long, you're long, you're... And it's trading. It's like Bitcoin now. It's not actually worth anything, but you can trade it all day, right? And that's that. But you're not going to be investing 40% of your net worth into something that's almost certainly guaranteed to lose money when adjusted for inflation. So the world has changed. The funny thing is, you're getting the same silly advice from your wealth manager. When you sit down in their cushy little office and you look up at the wall and you see they got a sports marketing degree from University of Eastern West Virginia. And you're like, oh, that makes sense now. They don't understand. Okay? Of course they did, Javier. I prepped you for over a week. I went on vacation because I told you the market's coming down. Anyways, so very interesting. The world has changed and people don't get it. So it's, right? So this is up to you guys. I keep telling you, and I don't know if you fully get it. The world needs you. And the current people that are in power, they're going to be kicked out of the market because they cannot earn enough to justify what they do. They cannot earn enough for their clients. There's a changing of the guard, and especially for those wealth managers that are near retirement. They don't understand. They've never needed to understand central banking. They didn't need to understand global macroeconomics, right? I'd say probably 2/3 of the wealth managers in the United States that manage $100 million accounts, right? They've never been to China. They've never been to India. They've never been to Brazil. They don't know the BRIC countries. They don't know Eastern Europe. They've been to England once, you know, and they've been to Mexico a couple of times, and that's their global view. Everything else they know because they got it on CNBC. And you're like, dude, you're just rehashing stuff you watched on CNBC yesterday, right? So there's going to be a changing of the guard. They're going to be forced out because they're not going to have consistent returns with low volatility. They're not going to be able to justify their fees, and there will be a changing of the guard. Okay? Claudio says, well, the Fed needs to increase interest rates to fight inflation. No, but that ain't going to happen anytime soon, Claudio. Like literally, don't even think about that for, well, let's say 3 years. But even then, it's probably not even thinkable till then. So wait at least 1,000 days before you bring that thought back. Okay, Claudio? It's all right to think, but it's not there yet. And there's actually, so what Claudio's bringing up is, you know, this future inflation. And I actually wrote in 2008, to get ready for hyperinflation. Of course, that never happened. And, you know, and this is something that economists are studying very closely, like why don't we have inflation? And it's because the developed economies, the OECD countries, are exporting their inflation to emerging markets, okay? And it just happened, it's a positive outcome of global trade. Okay? Right? So there will be an equilibrium point where third world countries, or I shouldn't say third world, developing countries, are going to bring up their middle class. Meanwhile, the United States is losing their middle class. Do you understand that there's a direct relationship between that? Let me say it again. Emerging markets and developing economies are building a middle class while the United States is losing their middle class. But it's an equilibrium. Okay? So here's a question. When's the best time to look for opportunities in the stock market again? Dude, I gave it to you on a silver platter through the entire month of February. Well, not the entire month, but most of February and half of March. I begged people to take it seriously. I told everyone, day after day after day, write down the list of the 10 stocks you want to own. And the only analysis you need to do is you believe they're going to be around in 10 years. If you didn't do it, it's over, dude. Like literally, you're not going to get another chance until maybe a big pullback this summer. But if you didn't do it last time, why would you do it this time, right? But I'll say it again. Create a list of 10 stocks that you'd like to own, and the only analysis that you're doing is you believe they will be in business 10 years from now. Then next time the stock market drops 5%, 10%, 15%, 20%, you buy it. So if you had a wealth manager, you just call the firm and you're like, yo, Next time, um, next time Delta Airlines is down 10%, buy. Whatever it is. Okay? Okay? But yeah, if you didn't act, you missed it. That's it. And by the way, it comes down to like if you miss 20 of the most important trading days in the last 10 years, I think. Was it 10 years or 20 years? I got some amazing statistic somewhere. It was like in the last 20 years, if you missed the 20 most important trading days, you are actually not profitable over the 20 years. To say it differently, if you just bought the dips in the big, right? In the big market crashes, if you will, if you only bought during the 20 days where there was blood in the street, you'd be profitable. And if you missed those days, you were not profitable even though you were in the market for the other 20 years. 20 years minus 20 days. It was like crazy. Yeah. But is there going to be another chance? I don't know. There'll probably be something by the end of the year. Okay. But I don't know. But there might be something by the end of the year. So, like one day, the logic shows up and you see something like what we were talking about. Okay. And somebody says, wait, the stock market is crazy overvalued. There's no way 2021 is equal to 2019. Therefore, everything is overvalued and comes down. That would be logical, except what else are you going to buy? Okay? You see what I mean? So we don't know if there's true logic here because the logic can change. So for example, the expected return of a stock is not the present value of future dividend payments. Because if that's true, then Apple's overvalued. Apple trading at 21 years earnings. But if there's no place to put your money in the bond market, well, then maybe Apple is pretty good because it's the only damn place making money. So you're like, well, I know it's overpriced, but there's nowhere else to put my money. So you put your money here. Now, I'm not saying that's the right decision because if you're just buying it now back at all-time highs, you will get punished eventually because it's a dumb idea, right? So whatever, it's just whatever. If there's nowhere else to put your money, it goes up. Why? Because it's worth it? What does that have to do with anything? You have to put your money somewhere. Your choices are stocks, bonds, real estate, and that's pretty much it for most investors. Okay? And most investors invest through a retirement account like a 401k. All 401ks lock you into mutual funds, and all mutual funds can only buy large cap stocks, right? And they're long only. So what do you think the stock market's going to do? Okay? So now, as sort of humans come in and now they want to start thinking, they're going to say, well, there might be another decline, like in the summer, not a 30% decline, but something. If we're going to move sideways in the summer, then sideways doesn't mean up, up, up. So there will be some down, down, down. And it might be some people thinking, okay, 2021 is not equal or congruent to 2019. Therefore, this is overvalued and needs to come down. That's logical, except probably 85% of people are long only and they invest through their mutual fund. That's why we know they're long only, right? And they're going to buy and 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 buy. right? Very, very few very few people make money on the way down. Okay. Well, master trader, that most people are not in foreign currencies. Okay. So anyway, so will there be some down this summer? Yeah, probably. The question is, are you a buyer? Like, especially with stocks, you can't. Most people don't just click a button and buy, right? You got to call your broker, and your broker's got to do something. Then there's T+2. It might take you 3 days to get into a trade. Why? I don't know why. It's just that's how it works. So you need to call them today and say, look, these are my 5 favorite stocks or 3 favorite stocks. And you say something like, if Carnival Cruises drops by 10%, buy it. And it might happen in a day. That's the whole point. They got to place the order for you, put it in the market, wait for it to drop. Okay? Something to that effect. Okay? If MGM Grand hits $10 a share, just buy it. And that's how you need to do it. Okay? But whatever. So let's move on. So there we go. So we got an interesting week ahead. Okay? Bank of England, more reading to do. Bank of Japan, meeting minutes, you got reading to do. Okay? China, got reading to do. Okay, retail sales, yeah. I mean, retail sales is interesting. Again, like, is there a sign of a recovery? Even if it's a small sign, that's a huge thumbs up. Okay? Well, Claudio, no, it's not a bubble, or I don't know where people get 30%. So whatever. It's a great headline. Okay. You got to remember, like, most of the stuff you read in newspapers and on television and stuff start with a press release. Okay. So you sit down with your PR people. So I've done this, by the way. I used to spend like $20,000 a month on PR. So I'd sit down with my guys in New York, and we would, in the office, hash out ideas. And one, for example, like hyperinflation. Okay, a foreign exchange expert predicts hyperinflation based on, you got to have some sort of headline, based on radical Fed policies. Okay? Ooh, that's tittillating. And then you write a little thing, okay, because of this, this, and this. And you kind of spell it out a little bit. And then at the end, it's like, okay, you can print this as an article. Wayne McDonald is available for quotes, interviews, and so on and so forth. And they might just bring you in and say, okay, you're going to talk about this press release, but they don't call it a press release. They just call it an interview, right? And then you sit down in front of the camera, and they're like, oh, so what do you think about hyperinflation? Oh, well, because of the radical policies of the Fed, I believe there's just going to be a hyperinflation. You're going to see it in blah, 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 blah. And it's just a thing to get you on TV or in the newspapers. It's a press release. So, like, you saw an article in Bloomberg about the dollar going down 30% in the next... Wow. Okay, great. How do they come up with the 30%? I don't know. They probably just made it up, honestly. So let's talk about the idea of, in the coming years, the dollar will weaken. Well, you already know that. I already told you that. I told you on the day it would happen. And I told you I'd probably stay shorting the US dollar for at least 5 years, maybe 10. How many people remember that on that day? That I'm no longer buying dollars, I am selling dollars. And I will probably stay this way for 5 years, maybe 10. Okay, that's it. How much will it fall will it fall 30% in the next 2 years? Why not 70%? Why not 20%? Like, I don't care, nor does it matter. Right? But it doesn't even matter. Just the declaration is enough. It could have been the day I flipped a coin. It was the day I made a guess. Absolutely, KG. Without a shadow of a doubt. 1,000 million times over. But you should already know all of this. Because that's been a month and a half, 2 months ago. When the Fed said they are not going to cut interest rates any further, then I was no longer a bull in the US dollar. That's it. And when they start raising, I will still be a bear on the US dollar. And I will become a bull on the US dollar when the Fed says they can't raise interest rates any higher because the market is already starting to decline. So this could be 20 years. Okay? So, yeah, don't have to overcomplicate it. So, there is a lot of work for you to do, not necessarily trading. You need to go to multiple central bank websites and actually print out reports and read them. Who's in my live trading group? Okay. I think you guys should download and read these central bank reports and come to the meeting on Thursday prepared to read one of them. That you'll volunteer and you'll stand up and you'll say, I have read and reviewed the Bank of Japan monetary policy meeting minutes, and I'd like to cover that for our group. I'd like someone else to stand up and read the other one, and someone else stand up and read the other one, and someone else stand up and read the other one. Okay? So, for example, we'll have one person read the Bank of Japan monetary policy statement. I guess this one won't be out yet. Which would be, the other one would be also very interesting, because this is what they actually talked about. This is the press release that they created after they talked about things, but this is them actually talking about things. Okay? But I would like it if you guys actually did the work, and there's at least 3 people then that need to volunteer and tell our group what was said and what it means. Yeah, well, Joe says I already got to do that anyways. Right, and now you got to lead the team. Okay? Okay? The cool thing, Joe, right? Like that might be an associate level project. So in this case, I'm a portfolio manager. I might be the expert in Aussie dollar. I have a couple analysts to go through all the charts for me. And then you as my associate, I need you to go through all the fundamental data and meet with the analyst and look for trades for and against your fundamental data, and then update me so I can make informed decision makers because I'm the portfolio manager, right? So if I'm a PM and my expertise is on Aussie, not only do I need the RBA meeting minutes, but I also need to know what's going on in Japan, because I'll probably be trading Aussie yen. Okay? You understand? Kemi, I need you to go to fxbootcamp.com, go through all the training videos, take you 50 to 100 hours, okay? And then maybe join the group. Okay? Yeah, Joseph is exactly right. So this, right, you need to learn how to be a professional trader. And so you have to get used to the idea that there are roles for people. There's portfolio managers, there's associates, and there's analysts. And one day you need to be able to manage a team like this. And then when it's all done, fight for your stack of money to trade your ideas. Okay. So anyways, there we go. So it looks like we got a really nice week. I'm looking forward to it. Hey, Daniel. Thanks for all the hard work, Daniel. I know you're putting in your time. All right. Easy peasy risk off. Easy peasy risk off. Okay. By the way, how do you feel now? So today's the 15th. We're halfway through June. On the very end of May, I explained based on behavioral finance that June would open up red hot. Markets are going to open out of position. They're going to rally up high. They're going to hit monthly targets early. And then you should be out. Because that could set up either consolidation or more likely profit taking. Because the smart money will make their money and leave the market and go to the beach with their family. And everyone else is going to be late like they were before and forced to trade and hopefully hit their money by the end of June before they have to report their losses to their clients, right? And so now, like, this idea that last week and this week, after a week and a half of consolidation, there's downward moves and the stock market drops 6% in 1 hour and all this kind of stuff is freaking people out. And yet we casually set it all up 2 weeks ago. How many people are starting to appreciate that side of trading, to understand the market and understand that the market isn't, Forex isn't Fortnite, right? Forex is a bunch of human beings getting together for an intricate dance. Like the majestic whooping cranes. And now, like, we're getting big profit-taking moves in the stock market, and you're like, yeah, that was so a week ago. Right? But isn't it interesting, though? That it can be done. That's the interesting thing, right? The interesting thing is it can be done. There are repeatable human behaviors, not necessarily technical patterns. Okay? And that if it's that predictable, then it's teachable, it's learnable, right? And it's repeatable. Right, Alejandro. Well, you should see the majestic dance of the whooping crane. It's really something. So anyway, so I look at this, you're like, yeah, that totally makes sense. Okay. So, like, let's break this down a little bit. Break it down. Break it down. Break it down. Break it down. All right. Okay. Big moves. All right. Breakout, pull back, gone. When you're setting up your longer term trades, what day are you supposed to trade? What day are you supposed to be ready to trade? Well, not that. Those are just swing trades. Longer term trades, a position trade. First of the month, yeah. Isn't that nice? And then to follow on with the weekly swing, Sunday. Cool. Check it out. Beginning of the week. Beginning of the week. Well, that one wasn't that great. But okay. Okay, so I don't really trade this pair. That's irrelevant. But notice if you were just a bull on Swiss franc because you were risk off. Okay? Or you were bear on USD because you were risk on. That's why I don't trade this. Do you understand that? But it's the same thing. So if all you were was a bear and you traded in here, you made money. Okay? And then here's sort of the beginning. If you were bear, because you don't sell here. So you, right? And then you sell here. And then you sell here. Okay? And then, well, you can't sell here. It's way out of position. And here's one here. And here's one here. Like, if all you were was a buyer of Swiss franc, or the opposite, the seller of a US dollar, either way you made money. Okay? Or if you want to flip it the other way, you might have tried to buy in here. Oops, let's make that pink. You might have tried to buy in here, but probably not that good. But this is definitely a buy. And then maybe you tried to buy in here, and that didn't work out that well. And this, maybe you tried. But you can see you got lots of opportunities to break even, or there's small little winners. This is out of position. Like a lot of these out of position ones you probably pass on. Maybe you tried here. I doubt it. You know, and you can see that, right? That there's little losses or little winners if you got it wrong. But if you got it right, you did much, much better. And it only had to do with if the market conditions agreed with you. Okay? So cool. So I don't trade this because I don't like to be in a situation where if this is, right, let me be clear. If this is falling, okay, that means risk on. Just the dollar. Okay? But if this pair is going down, which means the value of this is going up, this means risk off. And that's why I'm like, I know, right? That's why I don't trade this pair. Because if this is falling, it means two different things. So it's more, well, we don't know yet if it's more risk off or more risk on. We don't. Okay? It's not enough information. That's why I don't use it. Okay. Cool. Now, if you are a buyer on this pair, so you're risk on, you're missing your opportunity, bro. And I don't know why. Why would you miss that? If you're a bull on this, why would you miss that? I don't understand. Okay? You can see the target very clearly. There's the entry, and here's the exit. Okay? On this 4-hour chart, based on this much data, we are now 1 standard deviation from the mean. And it's below the mean, so it's, what is it, 62? What is it? Is it 62 or 68? 68% oversold. Yeah, well, like NP says, what a great buy. If you're a bull and you trade the pound, there's no way you miss that. And if you're missing things because you're not a specialist, why don't you take my advice and become a specialist? Yeah, it's 68. For an approximately normal data set, so you have to know if your data set is normal, and ours is normal. For an approximately normal data set, the values within 1 standard deviation of the mean account for about 68% of the set, while 2 standard deviations account for about 95%, and with 3 standard deviations, 99.7, which is stupid. It's not. There's a 99.7% chance the moon is not going to crash into the earth today. Meaningless, right? So I was just trying to like get back to, I want to make sure. So this is 68% oversold, closer to 70 because it went just beyond that. Right? Standard deviation of the set wait, it's hard to see. It's I equals 1. So anyways, these pretty colors here tell you that this is a buy zone if you're a bull. It actually doesn't tell you that. It tells you it's 68% oversold relative to the data set within these lines. And of course, the way that it's doing that is it's creating an average and how far price moves from the average. So you're like, woo, this is way oversold. Cool. So, but the money made here, guys, is that you already know you're a bull. You either want to buy the Great British Pound or you want to sell the US dollar. I don't care how you get there. And and all of that. And yes, if you're a bull, you missed this whole move down. Good. Shouldn't bother you. Okay? Then Tim, pop a squat and hang out for a year. Cool. Okay. So the money here on this chart is you've made a decision. It's not even that you're a bull. That's not even the relevant piece of information. You have to understand this. The way you make money is you've decided that you are a bull. You were here, 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 here. So now you're using algorithms and other statistical devices. It's like using a calculator. They're just statistical devices. You can pop anything on here. So you have to say, well, do I use the multiplication button? Do I use the addition button? Right? But the calculator can't think for you. So for you, if you said you were a bull, and you've been a bull, then all these tools are relevant to you because you're measuring and you're like, all right, based on my statistical analysis of the pound dollar over, for basically since over the last month, this is statistically a buy zone, meaning one standard deviation from a mean. It's also an M2. And those should be relevant information for you for planning out the week. It shouldn't make you bulls, right? It should not make you a bull. If you are become bullish because of that, you don't understand the message. If you look at your chart and then become a bull because of something on your chart, you don't understand. Okay? Okay. So if you're already a bull anyways, this is so stupid easy that that the only way you'd miss it is you don't know how to trade. Doesn't mean this is going to be right. It doesn't mean it's going to go up to here. What it means is your plan is, based on statistical analysis of your data set, that there's a high probability that it will go up there. Oh, sorry to hear that, Tim, but glad you're with us, man. Yeah. Well, Tim, you might have missed things like the day trading course, for example. But we got some crazy awesome things we're about to announce that will not just be awesome for Forex traders, but we're about to do things that no one in the financial education business, if you want to think of it that way, has ever done. It's on its way, man. Changing lives. All right. So if you're a bull and you know how to trade, you would have traded that and you're done for the week. It's only probabilities and statistics. The chart didn't make a decision. The algorithm didn't make a decision. There's nothing here that says buy. There's nothing here that says sell. That's your job. Okay? But if you miss that, you're not an expert, and maybe you should become an expert. Listen to the message. Don't get all pissed off at me. Okay? If you're not an expert, you need to become an expert. You need to specialize in Great British Pound, for example. And on top of that, you have an opinion whether the pound should go up or down. And don't say good news, bad news. That's nonsense as well. Right? That's nonsense. What do you mean good news? What do you mean bad news? It's news. It's data. Where's the market? How do people make money? That's the answer you have to ask yourself. How do people make money, or how do people protect their money? There is no good. There is no bad. There only is. Correct. Okay? But if you feel the flow of capital is going to leave Great Britain because of Brexit, then cool, right on. I appreciate that. That is an opinion. And if you had that opinion, you're going to sell this. And that's what it's going to look. And we're going to become 2 standard deviations below the mean. Good. And you will not miss that. Because you're an expert and you're an opinionated. Have you ever come across an expert that's not opinionated? Then they're not an expert. So you're like, well, I'm a bear on this because of Brexit. Cool. Thank you for that deep analysis. I really appreciate it. Good. So what are you going to do about it? This. And if that doesn't set up, nothing. Pure mathematics is algo trading. Did you guys get my hashtag no algos post? Okay. So again, I'll remind you, you're complicating things because you refuse to make a decision. And you might refuse to do it because you're afraid of being wrong. All of that is nonsense. You need to retrain your brain. I was thinking after I write the 9 other Forex books I want to write, I should do one on neuro-linguistic programming. Community. Working on the weekend. This is yesterday. Working on the weekend again and loving it. Hashtag love thy work. Hashtag no algos. "19 hours ago, that's what I was doing. And was I reading Little Women? Maybe some Friedrich Nietzsche? Maybe a good romance novel? Some Danielle Steele? I wish I can zoom in a little more. Performance analysis. Yeah, I'd like to read books about statistical analysis of trading data sets. Oh yeah, algos can be fun, sure. The problem I have with algos is 99% of people on YouTube are looking for an algorithm to make them rich. Yeah, sure, Joe. So, for example, my mother just sent me my memory trunk that she's collected for over 45 years, obviously. And she just moved, and she sent me all my stuff, my little toys when I was a little kid, during my whole entire life. And one of the things in the trunk was a book on neuro-linguistic programming. What? While you were playing with dolls, I was reading neuro-linguistic programming. Anyways, right? So that's just how to reprogram a brain. Okay? Your ears, your nose, and your brain never stop growing. And the cool thing is, because they're moving, if you think of growth as movement, you can actually rewire your brain and program it. Well, Daniel says you become what you believe. I very much dislike positive affirmation. You can sit in a corner and believe you're the best and absolutely do nothing. I'm a much more of a believer of acting than believing. Okay? Yeah, I know what you're saying, but you typed it, so I don't care. If you act like you know what you're doing out of fear because you don't know what you're doing, the fact that you're acting is better. No, I know. I'm making a point. You made a point. I made a point. I'm not picking on you. But I prefer action over feeling. Right? That's all. Right. Well, that's E equals MC squared, right? So the world responds to energy. So energy equals E equals MC squared. Okay. Okay. This is the speed of light. Speed of light times the speed of light. Let's just say it's a very large number. The speed of light times the speed of light. This m is the mass of your thoughts. We'll call it idea. Okay? You got the idea today that you are going to go out into your backyard and build a brick wall. Wonderful idea. Woohoo! Good job with your idea. Oh, well, I had this idea that I was going to invent the internet. Woohoo! Right on. I had the idea that I was going to build eBay. Awesome idea, bro. It's worth zero. The mass of an idea is zip, zilch, nada. But the idea that you're a good human being and you deserve so much, yeah, that's worth zero. Well, if I'm good enough and I'm smart enough, gosh darn, people will like me. Zero or nearly zero. Now, if you want to take that and make it a reality, you actually want to build a brick wall in your backyard, good idea. Multiply it by a boatload, ginormous number, and it can be done. To make this equate, all you have to do is have lots and lots of energy. It's the only way the math works. You want to be a successful foreign exchange hedge fund manager. Good idea. Good idea. You should do that. You should be a successful foreign exchange hedge fund manager. I think you will like it. You should do it. All it requires is energy. And according to the math, a lot of energy. You understand? Yeah. Hey, man. Right? I thought Joe made a mistake. I cried when Amy died. How about you, Hope? No, wait, Amy didn't die. I liked Amy. Which one died? Which, which one died? Which of the sisters died? I can't remember. Anyways, she was the good one. Everyone liked it. So there you go, guys. You should be a successful foreign exchange hedge fund manager. That's it. You have a good idea. Most of you will not be able to do it because you don't have enough energy. You have to have half a brain for sure. You can't be an idiot. I don't think anybody here is an idiot. So you have what is required. You can be a successful foreign exchange hedge fund manager. Cool. You can. I honestly believe you can do it. 4 years grinding. How about 30 years grinding? Okay? Okay? But if you don't have the energy, good luck. You want to get rich quick? I want to get rich, but I don't have any energy. Forget it, dude. Like, it's such a... You're lost in the dream. You're lost in the dream, and your dream has the mass that equates to almost nothing. Yeah, like this whole idea of like 4 or 5 years of grinding to get your track record, which you don't understand. And by the way, I'm not picking on you, Carlos, like I wasn't picking on Daniel earlier. But this idea, like if you can only put together a 4 or 5 year track record, you'll be there. Oh my God, you're like, you can now show up to tryouts. Right? Do you understand? Like once you got a 3 or 4 or 5 year track record, now you can show up to tryouts. Doesn't mean you're on the team. Doesn't mean you're a starter or a star player or a captain or a superstar or a franchise player. You're not even in the league yet. You're showing up, walking onto the field to try out. Okay? You guys understand that? Like, that's a sports analogy. I've always wanted to play football. I love watching it on TV. Put me in the game, coach. Well, did you win the state championship when you're in high school? And did you have a leadership role on the team? And do you have a letter of recommendation from your captain? Right? Like, no, but I love football. I love it. It's my number one sport. And I played fantasy football. Right? You're like, dude. So, yeah. So anyways, you need a lot more than the idea, guys. What your challenge is going to be is whether you have enough energy. Okay? I want you to know that. I want you to understand that the difference between those that make it and those that don't comes down to whether you're doing the right thing, whether you're, so there's number, right? There's like, how do you do this? What was it? Productivity, P prime, plus labor, damn it. Oh, dang it, I can't remember the math. Okay, so what I'm trying to get to, I forget there's, is it alpha capital or alpha labor? Probably alpha labor, and I don't remember how to do technology. And I remember this is squared and this is squared, but I can't remember the math. So anyways, what I'm getting to is you need E, okay? But there's a kind of E. No, no, Rob, I didn't say 30 years. Means 30 years from now, if you're not working your ass off, it ain't going to happen. It's not like you roll into 5 years, you got this track record, and money is going to rain out of the sky, and now you don't have to work. The work never stops. That's what I'm trying to tell you. The work never stops. And if you don't have a passion for this, it ain't going to happen if you, right? And I'm not saying that's you now, but I'm saying that's not what I meant by 30 years to get to a hedge fund. Meaning you might be managing $1 billion in 30 years, and guess what? It's not easy street. Now you manage $1 billion. Now you got like bigger problems and other problems and more problems, but you got a nicer car and you have an awesome office and you have multiple houses around the world, right? All that kind of stuff. So there's energy, but there's a form of energy which I guess you would do like the alpha of energy. Okay? How you use your energy will improve your, well, you can't change the M, that's constant. Well, the other things are constant, right? Your idea is always going to be the same, and the speed of light times the speed of light is always the same. So, but you can improve the outcome of this equation by how you channel your energy. Beth died? Thank you. Is that right, Beth? She died. Anyways, everybody cried, right? Did you just like Google that? Hope Spin's like, the name of the little woman that died in the Little Woman. All right? So anyways, how you channel your energy is going to be important. So just in the beginning, when I tell you, like, just go to the website and read the report. And I don't even care whether you understand it or not. I want you to be the type of person that will go to the central bank, right? Yeah, no, I know what you're saying, Hope. Yeah, Beth was the one that died and everybody cried. Yeah, that's cool. I liked Amy. She was the artistic pretty one that married Rich. And then Joe married the professor. And did anyone marry Lori? Oh, Amy married Lori, right? Anyways, whatever. Just there we go. What was I doing? Oh, in the beginning, as your coach, I'm teaching you to have energy, or I'm coaching you to have energy, and of course, most people don't. But if you can have the energy, just learning how to focus your energy, like not if you sit in front. Let me change the trend of thought here. If you think you sit in front of your charts 8 hours a day and trade, and that's the energy you need, you're sorely mistaken. Okay. By the way, Hope, I hope you appreciate that we can go from, quantum physics to Jane Austen and not skip a beat. And you're like, whoa, dude. Yeah. Okay. So if you think you can just sit in front of your charts and drop a bunch of trades and eventually, because you have so much energy, you'll become a better trader, that's not true. It's not true. You cannot just go golfing. Well, actually you can, but here's what most people do in golf. They golf once a week, every day, every week for 50 years, and when they die, they still suck as a golfer. They might have had a wonderful life, and they enjoyed the birds, but they didn't get any birdies, okay? The flowers and the birds, but no birdies, okay? So what you need to do is channel your energy. So let's channel that. And by that, I'll say the alpha, okay, of energy. And what if you spent 1 year of your life perfecting your 5-iron? That's all you did. Let's say 1 hour a day, every single day. You had a coach who taught you how to hold a 5-iron. A coach who taught you how to aim. A coach that could record your swings for you so that you can see what you're doing right and you can see what you're doing wrong. And then with very focused attention, you practice swinging and hitting a ball. Hitting the ball is not even that important, but eventually you're hitting a ball. And you're hitting a ball long and short, and you're learning how to punch it when you need to punch, keep it low, hit it high, all with a 5-iron. And in fact, you'll go out on courses and the only club you use to drive for your second shot, for your approach shots on every hole, par 3s, par 5s, par 4s, you're only using a 5-iron, right? And you can shape it, you can shape it to the left, you can shape it to the right, you can hit a high shot, you can hit low shots, you can even chip with the thing because you can open your stance, open the face, you can even chip with this thing. Now, maybe it's not the appropriate club at most of the time, but you get very good at hitting the shot you want with a 5. Okay? Now in year 2, you're going to try a 9-iron. But now you can play with the 5, so you spend 20 minutes a day with your 5, and then you spend an hour on your 9. You could do a flop shot with the 9, you could hit it 130 yards with your 9, and all kinds of shots in between. You understand, like, it's the focused energy that's most important, not how many hours you spend on a course. You can just play and play and play and never get good. You can just trade and trade and trade and never get past break even. So it's the focus of your energy. So are you learning? Okay? Are you practicing? Are you researching? And are you preparing to make decisions? Okay? Are you, right? So all this comes down to this. Are you an expert? What do you know? What do you know? What is it that you know? Because if you don't know anything, there's no way you're going to predict the future. Like, if you're a bull here and you missed it, you don't know technical analysis. It's all right. You might be wrong. You might be right on the long run, but you're not understanding technicals. And same thing with the bear. You know, if you're a bear and you don't see resistance up here and you're not prepared to sell a lower high, I don't think you know how to trade. I think that might be your problem. You made a decision to be a bear here. I'm not the one to decide whether that's wrong or right. Okay? So if you're a bear here on this pair, and you can give me 3 decent reasons why, very cool. Then you know, right? You just know that that's a sell zone. You just know it. There it is. Look, that's what technical analysis is. But it doesn't tell you to be a bear. But if you're already a bear, like, oh my God, it just crashed through multiple levels of support, right? Rallied up to a sell zone. Whether you're using price action or pivot points, it doesn't matter. They're just algorithms. Use a Fibonacci if you want. Fibonacci is going to tell you this. It's all the same, guys. It doesn't matter which one you use. If you're a bear, there's going to be a sell in here, and there's going to be probably further up a sell. Maybe here, but probably not. Okay? So if you're a bear, oh my God, it's wicked simple, right? There's that, or there's going to be something like that at the top. Cool. Very, 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 very simple. And right? And if you're a bull, yeah. Now it's a big drop, and there's definitely a risk associated with that. You're buying a lower low, very, very much risk associated with it. But on this time frame, the markets become neutral, and technically, you can be a bull here. Okay, you can be a bull here, but you're going to manage your risk appropriately because you can see that a bear is going to sell this. I mean, yeah. So now you just have to know which one you are. If you don't know which one you are, you're not an expert in anything, and you're missing the trades because you don't know where to look. Right? You understand? Like, you have to be an expert in something. Is this going up? Well, I don't know. Well, then you don't know what you're looking for. And therefore, if you don't know what you're looking for, you can't be looking for things in the future. You can't be laying in wait for setting up ambushes. Right? If you have no idea where the enemy is going to be, somewhere in 40,000 square miles of jungle, there's some bad guys. Well, they can be anywhere. What do you mean they can be anywhere? Right? That's not, you got to have some sort of strategy so that you know where to look and where to ambush the enemy and where to set up booby traps. You have to know your line of defense and where to fall back to. You have to have a plan B in case plan A fails. Right? So if you're a bull, there's a buy here. But if that fails, and depending on the velocity of the failure, there's probably going to be a second chance here. Wow, look at that. I just planned out the entire week. Now, from inside of this, you can start doing intraday trading and smaller time frame price action trades, right? So this is a swing trade. Okay? And inside of that, there will be day trades and intraday trades. So do I know if it's going to go up? No. Do I know it's going to go down? No. Stop thinking that way. Stop looking for the Holy Grail that's going to tell you what human beings are going to do tomorrow. Okay? What's most important is to recognize you're a human being. And if you don't know what you're going to do tomorrow, then therein lies your problem. Because everybody else you're trying to figure out, they already know. That's where I'd freak out. You're like, son of a gun. I'm in a market and I'm the only one that doesn't know what's going on. Everybody else does, right? Before I even started the webinar, somebody typed in like, hey, so is it going to be risk on or risk off, guys? I'm like, dude, it's New York Open. You don't even know that yet? Like, oh my God, people knew that last week. So it's a huge red flag. Like, you don't know what you're doing. Then it's not, your results are going to be very, very inconsistent. And we already know inconsistent results are not going to lead to success. So I would rather you say, hey guys, I'm risk on today. How about you? Versus, what are we doing today? What are we doing today? We're planning tomorrow. That's what we're doing today. And I want you guys to take heart with that. What are we doing today? Well, today we're planning tomorrow. Because today, it's already done. What are you talking about, right? Right? That's the interesting thing. So we get to a weekly M2. We get to one standard deviation from a mean on a medium-term trend that's lasted almost a month. Yes, there's been some pullback and stuff. Okay? Ginormous move down, but obviously support. And then no lower low, 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 but a higher high, and now a higher high, higher low, now a higher high, higher low. Wait. You know how to draw an oscillator. You're like, well, son of a biatch. The oscillator's turned up. Why? We're no longer making lower lows, but we are making higher highs. On top of support you knew last week. You knew all of this last week. Well, you knew this. You didn't know what price would do. So price comes down to the obvious zone. So let's say let me try to draw this even when we're up here, which is obviously a roll reversal, obviously a front run, okay, for bears. Okay, cool. But even when you were up there, you're like, okay, there's something going on here. Because I see the standard deviation analysis, what I call price pivots instead of market pivots. Okay, there's our price pivots. We're in a buy zone. Obviously, even when we're up here, guys, we're looking at this. So now, as a bear, you're like, well, there's definitely a take profit zone. But a bull is probably going to be laying in wait here. There's an ambush that bulls are setting up, right? How do we know we're there? Well, how about ginormous bearish engulfing candle? Good. Well, we expected that because everyone sold here. Why? That's price action, bro. Okay. And by the way, whoever sold here is probably going to want to sell here and target there. Why? Well, once again, that's price action and pivot points and technical analysis. I mean, that should all be standard operating procedure, right? Look at this. It's probably going to go like that. But that's obviously what is being planned if you're a bear. Cool. Now, if you're not a bear, you're saying, well, we're at support. I wonder if support's going to hold. Okay? Well, it held here, it held here, it held here, it held here, and it held here, plus it created a higher high. So what's going to happen after that? After you get a higher high, okay, what's going to happen next? What happens after you get a higher high off of support? Help me out. Higher low. Oh, look. It even gave you a roll reversal. How nice is that? So now you got a higher low, which is down here, on what used to be resistance is now support. It even gave you a roll reversal. Cool. So what do you expect after the higher low? A higher high, which we now have. So what do you expect next? A higher low. Okay? Now, what you got to be careful of is you need to anticipate what the bears are going to do. Bears are going to look for opportunities to sell near 126, and you'll know, okay, because it'll start giving you some bigger candles down this way. Okay? So somewhere between 126 and 126.50, this will drop. If bears want. Okay? If the bears want to trade, that's where they're going to do it. They're going to do it right there. Probably won't even hit it. It'll probably sell at 125.90. Why? 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 Because they planned it on Friday, dude. That's why you can't show up on Monday like, what's going on, everybody? Dude, what's going on? Well, we've already set up the execution for today's trade, so it just comes down to whether price hits it. And right now, we're planning tomorrow. Okay? So a bull will say, if this holds and tomorrow we're above it, then I will do something. Okay? A bull will also say, well, if we're up here and we're holding above this line, then I'll do something similar, but at a higher price. And if it's not doing those things, then I will not trade. Like, trying to figure out today is not going to be helpful. Carlos, I don't really care about Wednesdays rollovers and stuff. Back in the day, it was big. Carlos. So, like for example, you earned 800% a year interest only on Kiwi dollar versus Japanese yen. Okay, and I think it was like 700% on Aussie, that kind of thing, right? And Swissy was also some. Okay, so if you owned a U.S. account and a Swiss account, you could catch rollover in Switzerland and then catch rollover in the UK. Sorry, in the US. And each time, okay, this is all because of leverage, right? So this is 1 day worth of, right? But so was there a time when you traded rollover just to catch rollover? Yeah. I've never been a proponent. I've been an opponent of that. But did people do it? Oh, yeah. Okay. But right now, oil is the biggest one. You wouldn't you wouldn't position trade oil because you're paying something like 80% a year in margin. It's like 8% a day. Let's say it that way. So it's even worse than that. Yeah, you're paying like 8% a day in margin to be long oil. So you would day trade it, but you wouldn't position trade it. I'd rather you trade the CAD. Okay. But just imagine, like, why is there such a carry on it? Imagine you physically bought a barrel of oil and now you had to pay money to have it delivered to your driveway. That's what it's like. Okay? So you paid $40 for a barrel of oil, but they charged you $200 to have it delivered. You're like, son of a biatch, that's expensive relative to 1 barrel of oil. Yeah. Now, instead, if you just put it in a warehouse, they charge you rent for every barrel in the warehouse. Regardless of the price, it doesn't matter. So if it's $200 a barrel for oil, it doesn't matter. The rent is the same for the carry, for storage, right? So they call that carry. Those are carrying charges. But anyways. Okay. So anyways, guys, I think I'll leave it here. I think fundamentally you know what to do. Okay. But if I was risk off, I'd be very interested in this zone here. Well, Master Trader, that's a black swan event, and that has nothing to do with the other thing. But it's not an issue of a broker per se, because like Trader's Way, for example, they just place your trades into the interbanking system. Okay? But let's use that example of the Swiss franc debacle, the Swiss National Bank. Trader's Way entered all client trades into the interbanking system. Whether you were long or short, doesn't matter. You click a button and that trade gets executed into the interbanking system. And the market went crazy, massive black swan event, and it didn't affect Trader's Way at all. Why? Well, they weren't holding any trades. All your trades are in the interbanking system. Now, if you're trying to trade in the volatility, well, because they enter your trades in the interbanking system, any spreads, for example, or any slippage that happens isn't the broker. It's your trade in an illiquid market. And it's difficult to find someone to take the other side of your trade. Okay? So it's like selling your used Ferrari for $1 million. Well, it might be difficult to find someone to buy your used Ferrari for $1 million, assuming it's not a collector's item, right? And someone else might come in and say, well, really, I might give you $100K for it. And you're like, well, how about 900? Right? So it's not a good analogy, but I'm saying there's a market and there's a proper price, and people want to buy and sell at proper prices. And if you come in at a wrong time, there is no market. There is no one to take that price. There's no bids for your offer. There's no offer for your bids. So you might the price will have to move until you find someone. Okay? Now, other brokers lost hundreds of millions of dollars. The brokerage itself, not their clients, the actual brokerage. And brokers went out of business. Now, how is that even possible? Well, they were not entering trades into the interbanking system. Okay? It's known as B-booking. Okay? If your clients are making money, then you, as a broker, you don't want to touch those. You want to enter all those into the interbanking system. And if your traders suck and they lose on almost every trade, well, then it's very advantageous to trade against your clients. So if you knew there was a 95% of chance that your clients are going to lose money, you're going to take the opposite side of the trade. Master Trader says, is Trader Way A-booking? Well, I'm not saying that either. First of all, I'm not involved in those questions. But I'm trying to explain what happened and what that might mean. So a typical client will say they'll want to enter all their profitable traders into the interbanking system because they're profitable. And for all the ones that lose, oh, they might as well take the other side of those trades because they'll make money. Okay? So, Trader's Way, during the Black Swan event where suddenly everybody lost money instantly, I contacted Trader's Way and I said, is everything okay? And they're like, yeah, everything's fine. I said, you should probably send out a press release because a lot of people are freaking out because their brokers are not fine. They're like, yeah, that's a good idea. FXCM instead, Drew Niv, the CEO of FXCM, walked into the office that morning and found out, even though he's the largest Forex broker in the world, they are now bankrupt. In fact, they owe, what was it, $500 million or something crazy? Why? They were holding all the losing trades. Why? They were in the market trading against those clients. Well, actually, I don't know that. So I don't know what I don't know. And I only know what I know. So Alpari and FXCM and a few others, okay, went out of business because of the Swiss National Bank. Not because they were bad, not because of something, this, that, or the other thing, especially only because of the Swiss National Bank. Right? Rookie trader, I'm not saying anything bad about FXCM. Like I've said, I've been in the office and all that kind of stuff. Okay? Anyways, there was a situation where brokers went out of business because of the Swiss National Bank, and other brokers were not affected at all. So you have to ask yourself, well, how did that happen? Well, Trader's Way being a boutique broker, they don't have millions and millions of customers and all that kind of stuff. They're a boutique. So what do? They take an order and they place it in the interbanking system. And that's that. That's all that happens. Again, I'm not involved in those questions. I don't see I don't know the management of all that kind of stuff. But you can see in that situation, FXCM Trader's Way was just like, oh, well, we're fine. Why? All the trades are in the interbanking system. Whatever a trader wanted, they got. It doesn't affect them. Okay? And then the other brokers went out of business. Well, if they entered those trades into the interbanking system, then they would also be in the same situation as little tiny Traders Way, right? Where they're like, well, all our trades are in the interbanking system, so as a broker, this wouldn't affect us. But then you get these other brokers that have millions of customers, and they went out of business. So what occurred? Well, I don't know what FXCM did. I don't know what Alpari did. I don't know what the other brokers did. I don't know how they manage all this. I can only guess and extrapolate based on logic. But they certainly did something different, and they certainly went out of business. Right? So, again, I don't know anything about anything. I don't sit on management meetings with Traders Way. I don't know their risk management tools or systems, right? I don't see orders. I don't see anything. Like, they sponsor our community. Okay? And I don't know anything about FXCM. Yes, I've been in the office. Yes, I've met senior management, all that kind of stuff. But they're like, oh, let us show all our risk management tools and let us tell you all our inner secrets. Like, obviously, they didn't know that, right? And I've actually spoken with the former CEO of Alpari in the Middle East. And he's like, hey, Wayne, let us tell you all our risk management secrets. Like, I don't know any of that stuff. Okay? But we know what happened. And we know how it didn't affect Traders Way. And you can only guess, well, then something else must have been happening at the other brokers. That's all we know. Okay? That's all I'm saying. So someone asked me a question about if you do position trading and you have, let's say, 100 trades open, are you facing some other type of black swan event? Well, in a black swan event, you're going to get stopped out. And if it's truly a bad one and all your stops are close, yeah, you're going to get crushed, bro. Okay? Yeah, you'll get crushed. But that's the market. Okay? But most likely you don't have 100 trades open and they're so close they get jumped and you lose. But it totally can happen. Extremely rare. But have I seen it? More than once. Okay. But in normal market conditions, when you have 100 trades open, you're long every yen pair. You got 20 pound yen longs, 20 euro yen longs, 20 Aussie yen longs, 20 Kiwi yens, right? Yeah. And is there going to be a black swan event that knocks you out? Probably not. And is there any risk because you have 100 trades open? No, nobody knows you have 100 trades open. Nobody knows where your trades are. In fact, they're all so small, unless they're $10 billion per trade, like it's irrelevant to the market. And you are trading cash, therefore you are liquid. So is there any trouble getting out of those trades? No, you click a button and you liquidate it. Well, Wayne, it's $100 million. Dude, you can liquidate $100 million in a second. Try liquidating $100 million worth of real estate. Have fun. Try selling $100 million worth of physical gold. Good luck. Okay? So, a position trade that took you months to set up, well, it's called a trading business, right? That's how you do it. And are there flash crashes and stuff that could be inherent risks in the market? Yeah, that's why you use your stop. And if you have a large portfolio of positions, the vast majority of your positions should be safe just by how profitable you are and how far away your stops are. Okay? So anyways, I've talked too long. I apologize, guys, but you guys got me going on various things. So thank you for being on my team. I appreciate you. Remember, you have to have lots of energy, and then I need to teach you how to focus your energy. Okay? So I'm glad you want to be a professional foreign exchange hedge fund manager. That sounds really good. It's a nice idea. You better have a lot of energy, and ideally it's focused. The more focused your energy is, the faster you're going to be able to achieve and balance the equation. Okay? So you can do more in the next 3 years than most people can do in 20 years. I know it. Because I can help you focus it. We're building tools right now that are just going to be just ridiculous, shave years and years and years off that equation. But you got to have energy, and you have to be able to focus it so you can harness that energy. And you can do it. I am absolutely certain you can do this. Okay? And maybe you'll be doing this with me or for me. Okay? No, Master Trader. Absolutely not. Cool. Well, anyways, gotta go, guys. Peace on earth. May the pips be with you. May your profits be above average. I'll see you tomorrow. Happy Monday. Remember all the work you have to do. Remember all the work. All the work. We went through the calendar. You have lots of things to report. And if you're in my live trading group, I'm going to ask for volunteers on Thursday to stand up. Well, in this case, take the microphone and charts and walk us through each of those reports. So one person will do Bank of Japan, someone else will do Bank of England, and so on and so forth. Okay?